Learning Objective 4-5. Prepare equity method journal entries, consolidation entries, and the consolidation worksheet for wholly owned subsidiary where there's complex positive differential. And what we mean by complex here is there are several different items that account for the differential between the acquisition cost and the book value of the assets and liabilities on the books of the subsidiary. So I'm at Peerless and Special for template. Peerless acquired all of Special's common stock for $387,500. Special's book value at the time was $300,000, and Special paid $300,000 cash, and they paid an $87,500 note. And these are the items that account for the differential: inventory, land, buildings, and equipment. Specifically, the inventory needed to be written up by $5,000. I always phrase this because it's easy to get it mixed up. So what it'll say sometimes in the book is it'll say, or in an exam question, it'll say inventory was undervalued by $5,000. And then students are like, oh, undervalued, I should subtract it. No, undervalued means it should be written up. Overvalued means it should be written down. And be careful of that. Land needs to be written up by 10,000, and buildings and equipment needs to be written up by 60,000. The buildings and equipment has a 10-year useful life of 10 years. Got that? 10 years. Now, just another little hint: if there's a liability here, if it needs to be written up, it's going to be subtracted. If it needs to be written down, then it's going to be added to book value. So the total differential is $75,000. Cost of the acquisition is $387,500. Wait, let me put that in the right place. The book value is $300,000. I've got write-ups of $75,000. The fair market value of the net identifiable assets must be $375,000. That'd be $300,000 plus all the $75,000 in the write-ups. So then you would have goodwill of $12,500. So I really have here 4 items in the differential: inventory, land, buildings and equipment, and goodwill. Don't forget the goodwill. To make the acquisition, Peerless is going to record the following. By the way, if you like Peerless, you should get used to it, because we're going to be doing Peerless throughout. Peerless and Special are going to appear throughout chapter 12, I think. Yeah, Peerless, like making international acquisitions in chapter 12. Anyway, so the acquisition would be a credit to cash on the books of Peerless, of course, for $300,000, and then there's a notes payable for $87,500, and the debit would be investment in Special Foods, or investment in Special Food stock if you want. $387,500, and that's the same number as that. Now, Special Foods has some income. I'm trying to see where this is in the problem. Oh, there it is. It's $50,000. So debit, they're going to use the equity method. Debit investment in Special Foods. And I've mentioned this before, but I'll mention it again. Income from Special Foods. I'll mention it again, that you don't have to use the equity method. That the company can use the cost method, in which case it would eliminate the cost method when it does its consolidation. Then we receive a dividend of $30,000, so debit cash for the amount of money received, and credit investment in Special Foods for $30,000. Next, we got various write-ups and downs. So we need to write the inventory. Okay, I got ahead of myself here. We're not going to do the initial acquisition now. What we're going to do is we're going to go on and do business and go to the end of the first year after the acquisition. And there's a few things going on here. At the end of the year, the parent prepares for the consolidation, and they realize they got to do a couple things. The first thing is they realize that this inventory that was written up has been sold. So they no longer should write up the inventory by $5,000, i.e. they should write it down by $5,000. In other words, that write-up, think of it as a reversal of a write-up. And again, this goes to what I said in an earlier video. What goes up must come down. So they previously wrote it up, and now they're going to need it to remove that write-up, so to speak, which would be a write-down. Furthermore, they have this write-up of the buildings and equipment of $60,000. That extra $60,000 has to be depreciated over 10 years. So they're going to need to record additional depreciation that the sub did not account for of $6,000. And then they look at the Goodwill and they do an impairment. They check it for impairment, and they decide that the Goodwill is going to be impaired by $3,000, meaning that, again, what went up must come down. They were writing up Goodwill by $12,500, and now they determine that $3,000 of that does not belong there, and therefore they impair the Goodwill for $3,000. So the parent is going to have an additional $14,000 in expenses as a result of Special Foods activity. In other words, Special Foods reports its income. Right here, Peerless records its share of that income, which is 100%. But Peerless also has to record an additional $14,000 of expenses because all these write-ups that Peerless did about Special are no longer legitimate write-ups, so they got to be expensed. As we said, everything that hits the income statement is going to sooner or later be an expense. Not everything, but almost everything. Everything that hits the balance sheet as an asset is eventually going to be an expense. So we're going to reverse this journal entry here, and I'm going to debit income from Special Foods for this $14,000, and I'm going to credit investment in Special Foods $14,000. Now I'm going to come back to this point again and again, but one of the really great things about doing this on video is you have the option to watch this again. So if you want to see me explain this again because you think you got it but you're not 100% sure, then you of course can go back. You can scroll this video back a little bit. I think the scroll goes that way. And on my end, it goes this way. On your end, it goes that way. Anyway, you can scroll this back and watch that again. But I'll repeat the basic thing I said. What goes up must come down. You can't just stick assets on your balance sheet and forget about them. Rather, if you record assets on your balance sheet, eventually they're going to be expenses. Or you're going to sell them and you'll have a gain or loss. And the higher they were, the less the gain, the higher the loss. So sooner or later, an asset becomes an expense. Sooner or later, liability either gets paid off or it becomes a revenue, believe it or not. That sounds weird, but it's correct. Or it can be a reduction in expense also. Anyway, sooner or later, an asset is going to be written off. Therefore, if you write up things when you make an acquisition, you have to be prepared to eventually expense them. And the sub is not going to expense them because the sub never recorded them in the first place. So if you determine that your buildings and equipment is worth $60,000 more, that means that you can't just put $60,000 on the balance sheet and forget about it. You have to depreciate it. And you're going to have to depreciate it on top of whatever depreciation Special is recording. So therefore, we're going to need to reduce our income from Special by $14,000 for these specific items. Alright, now let's do a consolidation. I have this spreadsheet all set up. If you don't remember how the spreadsheet works, then you probably want to go back and review. The first thing that we're going to do here is we're going to do what's called our basic elimination entry. I like to call it the big entry. I'm going to debit income from Special Foods for whatever the posted income was for Special Foods. In this case, it was $50,000. I'm going to debit the beginning balance of retained earnings and credit for $100,000 for its balance, and I'm going to credit dividends paid by the sub to the parent. I'm also going to debit common stock of the sub way down here, $200,000. And the difference between all of these is going to be credited to the investment account. So that would be $50,000 plus $100,000 minus $30,000 plus $200,000 or $320,000. And let me highlight all of that. That we call the basic elimination entry or the big elimination entry, and usually you do that first. There you go. Next, I'm going to do a little work on my income statement. And I've got some additional expenses to record here. If you remember, I have additional cost of goods sold of $5,000. So it'll be debited to that. I have additional depreciation expense of $6,000. And I have an impairment of goodwill of $3,000. And these go to adjust the income from special foods. So that'd be $5,000 plus $6,000 plus $3,000. A reduction of $14,000, and that reduces. See, Peerless recorded $36,000 in income from special foods. Why did they do that? That was $50,000 minus the $14,000 reduction over here in this journal entry. That's where they got that from. Now we've eliminated that completely, and consolidated income is the same as consolidated income of the parent. Next, let's work on the balance sheet. This is what we have so far in the balance sheet, and we need to do our individual write-ups. And when we do this, we got to be very careful because we have to think about the write-downs that we did. I started off with a $5,000 write-up of inventory. That would no longer make any sense because I wrote it off. Right here, it became cost of goods sold, so I can forget about that. But I do have a write-up in the land, which was of $10,000, and I have a write-up of buildings and equipment for $60,000. Accumulated depreciation. Let's not go there yet. Sorry. I've also got Goodwill, and this is very tricky. Goodwill started off at $12,500, but then I wrote off $3,000 of Goodwill. So Goodwill is now going to be $9,500. And I'm going to look again to make sure that I've got everything, and that should be everything. Except the depreciation. That's almost everything. Sorry about that. I've got additional depreciation to record on the building. Because this depreciation that the sub is recording doesn't include the $60,000 write-up. So I've got to record that additional depreciation on the write-up. And the difference between all of these, 10,000 plus 60 plus 95 minus 6,000, is going to be 73,500. And you know you did a good job when the investment account eliminates down to zero. And then we have the optional accumulated depreciation entry. I think the book calls it optional. It's not really optional. It's $300,000. You're probably looking at like, how do you know it's $300,000? And I always get questions about this because the problem doesn't say that it was $300,000. In this case, the information is actually not given to you. But you can figure it out because ending accumulated depreciation is $320,000 and depreciation expense for the period was $20,000. So you can figure out that, here, let me do a little T account. So we had $320,000 to end as a credit, and I recorded $20,000 in accumulated depreciation during the period. So the beginning balance must have been $300,000. That was the amount of accumulated depreciation at the beginning of the period when we made the acquisition. A lot of problems don't give you this number, and it's not always $300,000, so you need to back it out using this technique. And students like, but this is like a gotcha kind of thing. I thought, Dr. Holtzman, you don't like to do gotcha things. You know what? In the accounting profession, this happens all the time, and you got to figure this stuff out. So I think this in particular is a really good example. And again, you're going to make sure your debits equal your credits, assets equals liabilities and stockholders' equity, retained earnings flows down from the retained earnings statement. Make sure everything works. You know, it's like a Sudoku puzzle, and everything's got to go work in every direction and so on, and you want to be very mindful of that. So let's just look at this net income of $176,000 for a minute and see how we got it. We had separate income for Peerless of $140,000. Specials net income was $50,000. We had the write-off of the inventory of $5,000. We have the write-up, the amortization of the additional depreciation on the building, the $60,000 write-up divided by 10 is 6,000, and we had the goodwill impairment loss of 3,000. So that would give us consolidated net income of $176,000, which is exactly what we have there. Another thing to look at is to roll forward retained earnings. Roll forward. It's very important in financial accounting, by the way. I find this is a term. I know when I started working, I didn't know what a roll. They said do a roll forward. I'm like, what's a roll forward? That's just a roll forward. Roll forward. And I don't think in college we ever teach you what a roll forward is. So what a roll forward is, I'm going to have the honor of doing this for you right now. A roll forward is when you explain why a balance sheet account changed. So we've got beginning retained earnings, and I'm going to explain to you why retained earnings ends with 416. What changed retained earnings? My beginning retained earnings, actually it's not even here, is it? I'm sure it's explained in the book someplace. It's $300,000. Peerless's retained earnings on the date of acquisition, $300,000, and then Peerless's income in 2021 was $140,000. Special's income was $50,000, and then it had those three adjusting items, and then Peerless paid dividends of $60,000, and therefore ending retained earnings would be $416,000. So a roll forward explains why a balance sheet account changed from the beginning of the year until the end of the year. Oh yeah, where did beginning retained earnings come from? It's right over here on the retained earnings statement, obviously.